Hello, I'm Joseph Quijano, Certified Financial Planner.
And I'm Jordan Quijano. We want to thank you for coming back to Fireside Chats Episode 4. And tonight we're going to be talking about RMDs, or in other words, Required Minimum Distributions. What you should do with them, what's the deal with them, what to expect, and how you can start putting that money into action.
This is another way that the government handcuffs our hands. Because see, they want to have control of the money. You know, that money in a 401k or IRA has not been taxed.
Right.
So that means that the government cannot wait to get their hands on their taxes. So they actually have set a rule that you have to take money out of your account, either a 401k or IRA. I guess they extended it now to age 72 and a half.
Well,
right?
yeah, and this is something every day when we're meeting with our clients, or every week, we hear that this is a concern for a lot of individuals that maybe don't need their money quite yet. They don't want to accept that they're going to have to take that money out and start paying income tax on that. That's going to add additional money into their end of year taxes, and a lot of people don't want to get to that next tax bracket. So we see this on a regular basis. When you get closer to that 72, most people are almost fearful of having to take that money out, because if you don't take the money out, well, Uncle Sam's going to tax you or give you a penalty up to 50% of the money that you should have taken out. So that's pretty bad.
That's a pretty steep penalty to pay. 50% of the money that you should have taken out. So in other words, Jordan, you know, the government is going to throw you in the fire.
It's very
It's going to throw you in the fire unless you take money out on required minimum distributions. They're going to burn you with a 50% penalty.
It's important for everybody to understand, though, how is this calculated? How do they figure out how much money you're supposed to pay in RMDs? I mean, I know any of my clients have asked that question numerous times, is what do they know what they're going to pay? And that comes down to a couple variables. You know, this is something that isn't just a blanket statement that you know exactly how much you're going to pay. It's based off of each individual, based off of how many accounts you may have that are qualified. That's IRAs, 401ks, 453s, you know, any qualified account that you postpone tax on, that's what they're looking for. So when you look at those accounts, you look at your age and you use the IRS tables, you put it all together, they're going off of your life expectancy. And based off of that, they'll say, on your equation, if you've got X amount of dollars, you're gonna have to take out of all three of these accounts, $30,000. Now, one rule though that's important is you don't have to take that $30,000 out of just one account, or I should say out of all three accounts. You can put it out of just one account is what I meant to say.
Right.
You know, you could take 10, 10, 10 if you'd like, because that's what they're forming it off of. Or if you just want to take it from one account, you're able to do that. And that's what I found a lot of people wanting to do these days, is just take it out of one account, let the other accounts grow, do what they need to. And with that money that they have to take out, that's the question at that point, is now what to do with it. I don't want to just put it at the bank, right?
Yeah, I mean, definitely. You don't want to put this money in the bank and get less than 1%, right? And be taxed all over again.
That's
right.
crucial.
Double taxation.
Yes.
So what we do with our clients, we have a very specialized product called Become the Banker. We have a lot of experience in this area. And what we advise our clients to do in our situation is to actually use this money, this require minimum distribution income stream that is fully taxable, and not place it in the bank. Okay, we don't want people to place this money in the bank
Or an investment.
because they're going to lose money, number one, and number two, they're going to be taxed
Again.
So it's double taxation. Think about that. So what we advise our clients to do is to put this money in a very specialized product and a very specialized strategy called Become the Banker that is totally tax free.
And it stays tax-free. Yes.
Not only on the growth, but when you take the money out again. So it is the best of both worlds. Become the Banker can help you manage the required minimum distributions and actually avoid taxation again.
Yes. So aside from the taxes, you know, people really sometimes want to get ahead of the curve. How can they stop this before 72? And there's some ways to do this. If you take those qualified accounts, you can do what's called Roth conversions. That means take control of your money now before you get to that point by switching it over to a tax-free bucket of money. You could wait at the end, which, unfortunately people do, and that's what we're talking about with using to become the banker, taking that money and putting it somewhere tax-free. But before that happens, why not do it before? Use today's tax bracket. If you saw our video last week, which was talking about those 401ks, pros and cons, you understand that more than likely taxes are going to have to go up. So that begs the question, why not start doing Roth conversions earlier with today's tax bracket instead of waiting 5, 10, 20 years from now when more than likely the brackets are going to be higher and higher? This is important. So if you're with the right financial advisor and the right team, they can help you with this. They can help you get your foot in the right direction by taking the necessary amount of money out without putting you in the next tax bracket. That's crucial. You can only take out so much before you hit the next bracket. And we call that, bracket creeping. You get to it right below the line with your CPAs and with your financial advising team, and make sure you take just the necessary amount out, pay your taxes on it, and put it into a tax-free area like a Roth or become the banker. You can't escape the taxes. I think that's important to know. I always get that question from all my clients is there a way to just get rid of it without paying taxes? Not yet. We haven't figured that out yet. But if we do, we'll let you know, because that'd be the groundbreaking information. But there's no way to really escape that without paying the taxes, and it's okay, because you need to pay what's necessary on that money. It's never been taxed before. So pay the taxes, get it somewhere else that's tax-free, and never pay taxes on it again. That's the key.
So you were talking, Jordan, about people doing Roth conversions, which is great. It's a great strategy. But the Become the Banker strategy has been actually called a Roth in steroids.
Right.
It's much bigger, it's much powerful than a regular Roth.
Absolutely.
I mean, a regular Roth still has constraints as to how much money you can put into them.
Right.
The Become the Banker has no constraints whatsoever. That means it is a Roth, basically, but a Roth on steroids. And once people really understand that, they love it and they convert it to a Become the Banker mega Roth.
Great point. You're absolutely right. There's no limitations or contribution limits to how much you can put on the Become the Banker, because you are limited to the Roth. Yeah. That's a very strong point. So to take away from this is you need to make sure to either start focusing on those RMDs today or tomorrow, because at the end of the day, you can't escape them. Whether you don't want the money and you have to take it out to pay your taxes, because that's what all it comes down to, is Uncle Sam wants their taxes from it. So take that money that you got from your RMD, put it somewhere that you're not going to get taxed again, like to Become the Banker, and get some beautiful rates of return without risk, liquidity access, and if you pass away, then that even passes on tax-free to your loved ones, maybe 2 or 3 times fold. That's what to Become the Banker. The other option is to get ahead of the curve. Like we said, maybe don't wait until it's too late when you get to 72, but start doing what we call the Roth conversion or Become the Banker conversion, where you're able to start getting the money rolled over to a tax-free area beforehand. But again, I want to make sure it's clear, you can't escape that taxation. You're just paying taxes on a lower rate, which would be today's interest, or today's tax rate, instead of 10 or 20 years from now when you get to 72.
That is right, Jordan. Yeah. And you know what, ladies and gentlemen, if you have any questions, we have the answers.
Absolutely.
We have been actually in business for 50 years, and we love to welcome you into our homes. I love the fireside chats. I really love them, and thank you so much for joining us. And I want you to subscribe to our channel, like us, hit the notification bell, so we'll let you know when the next video will come around.
Absolutely. We look forward to seeing you on the next fireside chat.
Thank you.